It's tough to find values in a market like this when it seems like every stock is trading for more than 10 times sales, but there are values out there. And one of those that I think has a really nice moat around the business and a lot of growth potential if you look out 5 to 6 years is MGM Resorts. The company is buying back stock at an extremely rapid rate, about 15% per year. So that means the shares outstanding are dropping and the stock has actually been falling as well. So those buybacks may kick up at the end of 2024 and starting in 2025. I'm going to go through everything you need to know about this company today and why I am buying stock in MGM Resorts. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with an overview of MGM Resorts and what investors are actually paying for the stock right now. I'll start with this chart of the company's market cap. And as I'm recording today, the market cap is about $9.63 billion. Keep that number in mind because where I'm going to start this is with the enterprise value you're actually paying for with the business. Then I'm going to go here to the rest of the balance sheet and we're going to add in long-term debt. So that's $6.23 billion plus the current portion of short-term debt, that's $0.68 billion. And then we're going to subtract out the company's cash, about $3 billion. After all that, you get about $13.6 billion for the enterprise value for the company. And there's some nuances in this. Not all of this cash is held under MGM Resorts. Some of it is under their Macao properties, MGM China, but they do consolidate that. Same thing with the debt. So I'm kind of overlooking all of that to just simplify the analysis here. So $13.6 billion enterprise value. So what we're going to compare that to is their operations. This is the adjusted property EBITDAR that also takes out rent. I'll add that back in here in just a second. But you can see that MGM Resorts is doing about $1.1 billion worth of adjusted property EBITDAR. That's pretty consistent, maybe a little bit higher than that for the 9 months that were ended at the end of September. The run rate is about $1.2 billion. And you can see that there's $731 million coming from the Las Vegas Strip, almost $300 million from regional operations. This is a 3 months. MGM China, I'm going to get to their trends in just a little bit, but that's moving higher with $237.4 million. And then there's some negative numbers, especially for corporate and stock-based compensation, things like that. So let's assume you get another $1.1 billion worth of adjusted property EBITDAR in the fourth quarter. That would mean for 2024, the company is going to generate $4.7 billion in adjusted property EBITDAR. What we're going to then do is subtract the rent payment, $1.8 billion. Once you do that, you get $3.9 billion in adjusted property EBITDA. That's a proxy for the cash flow before you make investments in new resorts and things like that. Doing capital expenditures, they're going to spend $830 to $860 million in capital expenditures. $600 million of that is maintenance CapEx is what they call it. So that's going to be kind of the cash flows coming in before those investments. But here's the crazy thing. The enterprise value of MGM Resorts is only 3.5 times adjusted property EBITDA. That is an extremely good valuation, and it's implying that the business is getting worse. But that's not really what we see in the numbers, especially if you dig into them a little bit. Now, this is the gaming data coming from Las Vegas. They put this out every month. It's a little bit delayed, so we don't have the December numbers yet, but this is the November numbers. You can see that gaming was down about 4% in November. For the 3 months ending in November, down about 3%, and then about flat over the past year. Now, this is after a massive recovery coming out of the pandemic. Las Vegas is one of the first areas to recover and actually overshot what they were doing before the pandemic. So revenue over the past 12 months is much, much higher than it was pre-pandemic. Go from about $6 billion to about $8.8 billion in the Las Vegas Strip. In Macao, this is the other region that really matters. These are in Macanese Patacas, but you can see growth last year, 18.6%. And just in the past month, you're increasing that growth rate. So if these levels of revenue continue, we're going to continue to see growth in Macao. That's where a ton of cash flow is coming from. So the cash flow continues to come into the business. There is debt on the balance sheet, but not a lot of debt coming due, just $500 million in Macao. That would be in 2025. So when you look out to 2026, you get $750 million, $400 million due for MGM. But the company has excess cash on the balance sheet of about $1.1 billion. That's including all that cash of about $2.6 billion. And then they need to have working capital and a minimum amount of cash per their policies. Basically, you have to have cash on the balance sheet to cover both your operating expenses and any gaming losses that you may have. But the balance sheet looking really good, cash flow looking really good. Now, I'm going to dig into this a little bit more in just a second, but they're also buying back shares at an incredible rate. 40% of shares outstanding have been repurchased in the last 3 years alone. That pace could actually pick up because the stock has dropped a bit recently. Now, there's also a couple of reasons to be bullish on the company long term, the growth story. So I've talked a lot about the value story in MGM, but the growth story still exists as well. That's coming from a lot of these digital markets. BetMGM is their operations in the US, that's 50-50 owned with Entain, and they're in 29 North American jurisdictions. You can see those dots right here, but they are growing into Brazil, they're growing in Europe, and these are, some of them are partnerships, but some of them are wholly owned as well. This business has not really started generating cash flow. That should move from a business of investment to a business of cash flow over the next year or two. So look for that to be something that's going to help increase MGM Resorts cash from operations. And here's the big one, Japan. They own 40% of the only casino that's going to be built in Japan. There's also options to add casinos to a property in the UAE. So there's optionality there. Those three drivers, digital gaming, so online gaming, Japan, and the UAE, basically not priced into the stock. You're not paying anything for those future growth opportunities. That's partially because those opportunities not really known today, exactly what the scale of those opportunities are. And some of them, like Japan, are going to be further out in the future. So investors have a really hard time figuring out, okay, yes, maybe this is going to be a really big casino, but if it's not going to generate cash flow for another 6 or 7 years, why are we going to value it into the stock? That's upside for you as an investor. If you're buying shares now and building a position, they're buying back shares, remember, at a 15% or so rate on an annualized basis. That's going to reduce the number of shares outstanding when this growth property opens up. I love all of these trends for MGM Resorts. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. And then you can get to the overarching thing for MGM Resorts, and that's that these destinations, that there's a critical mass of not only ways to get to them, so ways to actually travel to Las Vegas, much easier to get there than it is to go to almost any other city in the US. There's these massive destinations internationally. This is one of them that if you're meeting up for a big conference, if you have to get together as a team because your business is spread all over the world, Las Vegas is going to be one of the places to go. And so that's going to be something that can't easily be replaced. It's going to be a moat around the business. Remember, this is geographically constrained. The Las Vegas Strip is only so big. It's only expanding so far. MGM owns arguably some of the best properties on the Las Vegas Strip. And they highlighted this on a recent presentation, but they are right next to the football stadium. They have a couple of their own arenas. T-Mobile Arena, which is where the hockey team plays, where potentially a basketball team could play in the future. That is on MGM property. So this is a company that I think has a ton of tailwinds, a very, very sticky business, and the valuation is just too good to pass up right now. If management continues buying back stock at this price, I think when the market finally figures out that this is ultimately a growth story with their online gaming business, and particularly with that Japanese casino, this is a stock that could really rise in value because that denominator for earnings per share continues to go down so quickly. So this is one of the opportunities that sometimes comes up with value stocks where the stock is just trading for such a cheap valuation that management is just saying, you know what, we're going to buy back as much stock as we can. Like I said, they had that $1 billion in excess cash left on the balance sheet. They could have spent a whole bunch of that in the fourth quarter or early in 2025, just given the valuation. They know the trends of the business better than the market does. So it'll be interesting to see how opportunistic they were. They'll start giving out some of their information from both their online gaming business and then their traditional gaming business. Both of those will be coming out next month. Online gaming on the 4th, and then MGM Resorts overall on the 12th of February. So I'm going to be covering those here on Asymmetric Investing. So come back to see how the business is doing. But I think there's just too much value, too much growth potential for MGM Resorts, a company that I don't think it is going anywhere, and would be happy to buy more if shares see any weakness in 2025. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.